Trade receivables. Trade receivables, also known as debtors. And what are trade receivables? Trade receivables, candidates represent amounts owed to a company by its customers for goods or services sold on credit. If a company sells goods or services on credit to another company, then that other company is a debtor or a trade receivable. Trade receivables, also known as debtors, represent the amount owed to a company by its customers for goods or services sold on credit. Measurement. How are trade receivables measured in the financial statements? Now, under International Financial Reporting Standards number 9, trade receivables are typically measured at their original transaction price. Are measured at their original transaction price. The invoice price, which is the amount of consideration expected to be received. If you sell to a debtor goods valued at 1 million, the invoice price is 1 million, then it is that 1 million that is recognized in the books of the seller. The amount of consideration expected to be received, which is the original transaction price, is the amount that is recorded in the books. However, the standard also requires companies to assess the expected credit losses associated with trade receivables. If you have trade receivables in your books or debtors in your books, the standard requires you as a company or as a seller to assess the expected credit losses associated with such debt or receivables. Credit losses. The standard requires the seller to assess the expected credit losses. If you are selling goods or services on credit to your customers, you are required by the standard to occasionally, to periodically assess the possibility that the debtors will not pay. Expected credit losses. Expected credit losses. when you sell goods or services on credit, there is a chance that the debtors may not pay due to one reason or the other. Those who just refuse to pay, even if they have the money. There are those who may not have the money. There are those who may go bankrupt. Others may pass away. So for one reason or another, the debtors, all of them may not pay. That's why the standard requires to assess the expected credit losses associated with the trade receivables. And credit losses occur when a company is unable to recover all its debts. Credit losses occur when a company is unable to do what? To recover the full amount owed by a customer. So when I sell you goods amounting to 100,000 and I only recover 90,000, then it means 10,000 is a credit loss. So IFRS number 9 mandates the use of expected credit loss model to estimate potential credit losses. And the model involves assessing the probability of default and the potential loss given to the defaulters. Expected credit loss model. Now, in applying the expected credit loss model, expected credit loss model in applying this model, I've just said that the standard mandates the use of the expected credit loss model to estimate potential credit losses. And the model involves assessing the probability of default and the potential given to default. So the steps in the expected credit loss model involve: 1. Initial recognition. This is what we call initial recognition. Trade receivables are initially recognized at their fair value, which is usually the transaction price. Recognized at fair value, which is equal to the transaction price. Initially, when you sell goods or services on credit, the value of the credit sale is the fair value, which is the transaction price. That is the initial recognition of trade receivables. Then we have subsequent measurement. Subsequent measurement. After the initial recognition, how are trade receivables measured? Subsequent, following after the recognition, initial recognition, how are trade receivables measured? They are measured after every 12 months. Companies must estimate the expected credit losses that are likely to occur within the next 12 months. 12-month expected credit loss. You understand? Companies must estimate the expected credit losses that are likely to occur within the next 12 months. That's why you keep this in mind, candidates, when we be doing the financial statements of companies. You will notice that at the end of the accounting period, under additional information, there will be information in relation to provision for bad debts written off. You'll be told in some questions that the company has decided to increase the provision for bad and doubtful debts from 5% to 10%. That tells you that at the end of every 12 months, companies must estimate the expected credit losses or the what we sometimes call provision for bad and doubtful debts within 12 months. And that involves considering factors like changes in economic conditions, the specific information about the debtor. If you get information about the debtor, that the debtor is bankrupt, is unable to pay debts, has been taken to the courts, is closed the business, then you are required to write off such a debtor. So after the end of every 12 months, if you are the accountant of a company, you are supposed to ensure that trade receivables are evaluated. All right? You have to ensure that you check the expected credit losses for each and every trade receivable. And you have to consider factors that I've mentioned. So that is how trade receivables are measured subsequently. Subsequent means after the initial recognition. When the transaction is first entered into, selling of goods or services on credit, then the initial measurement is the fair value of that transaction, or the transaction price, or the invoice price. Then after that, you have to do subsequent measurement. At the end of every month, you have to evaluate the value of the trade receivable. You have to check if there are any expected credit losses, and we've defined expected credit losses as the losses that the company may incur as a result of inability of a debtor to pay. Credit losses occurs where the company is unable to recover the full amount owed by a customer. Is that clear, candidates? So you will, in your exam, you come across items like bad debts and allowance for doubtful debts. So bad debts refer to the accounts receivable that a company determines it cannot collect from its customers. If after reviewing the trade receivable at the end of every month, and the company determines that debtor A, B, C will not pay due to various reasons, then that amount of money that may not be recovered from the debtor is what we refer to as a bad debt. And they arise when customers fail to pay their outstanding bills despite reasonable efforts to collect the debt. The company may have made reminders, the company has even taken legal action, the company has pushed, but the debtor is unwilling to pay. So bad debts represent a loss for the company and can significantly impact its financial health. It is an expense, so it is part of the expenses. It reduces the profit. That is bad debt. Then we have provision for bad and doubtful debt. Bad, I've explained what a bad debt is. Then you will come across provision for bad and doubtful debts. Sometimes, other than using the word provision, we use the word allowance. Allowance for bad and doubtful debts. So a provision is an allowance. Now, to account for potential bad debts, these ones are already, it has already happened. This is already determined to be bad. But we also may have potential bad debts or expected bad debts. There are debts that are already have happened. The company has determined that this debtor will not pay. That one, we call it a bad debt. The money will never be recovered. So you write it off. But we have what we call allowance for bad and doubtful debts, or provision for bad or doubtful debts. To account for the potential bad debts, companies establish what we call allowance for doubtful debts. Allowance for doubtful debts account, which is a contra asset account that reduces the net realizable value of accounts receivable on the balance sheet. And this account estimates the amount of accounts receivable that the company expects to be uncollectible. This one has already happened. But the allowance one, the company is expecting that this amount of debt may not be collected. So the company essentially estimates the amount of accounts receivable that the company expects to be uncollectible. You understand? So then that begs the question, how do you then account for bad and doubtful debts? Accounting for bad and doubtful debts. Accounting. First, we have the bad debt. How do you account for a bad debt? So to account for a bad debt, we credit the trade receivable account with the amount owing. Then we debit the profit and loss account. So the P&L account is debited. To account for bad debts, we debit P&L and credit trade receivable. But what actually happens, candidates, when you have a bad debt, you have the debtors account. Maybe there is a balance of 500,000. But out of this 500,000, 100,000 may not be collected. So you credit this account with the bad debt account. So you open the bad debt account. So this account is credited, then you debit this account with the debtors account, 100,000. Then towards the end of the year, you close this account to profit and loss account. So you credit bad debt account, then debit profit and loss account. You see that? That's how you account for bad debt. That's the long route. You understand, candidates? So accounting for bad debt, one transaction is to debit, let me go the long route, debit bad debt account, credit debtors account. By crediting debtors account, you're reducing the debtors account because that money will not be paid. Okay? You understand? Then to close this debtors account, you credit the bad debt account and debit the profit and loss account. That is how you account for bad debt written off. So about provision. How do you account for allowance or provision? Allowance for bad debt. How do you account for the allowance? This is the expected bad debts. The bad debt in the first instance, these are debts that have been written off. After writing off, these are the entries. How about the allowance for bad debts? Now, the accounting treatment of the allowance for doubtful debt depends on the year of trading. It depends on the year of trading. Depends on the year of trading. It depends on the year of trading. Please pay attention. Please pay attention. Accounting for allowance for bad debts, first of all, depends on the year of accounting. The year. Depends on the year of trading. If it is the first year of trading, one instance is first year of trading. The first time you sold these goods to the debtor, that very first year will be different from subsequent years. This is the first year. Accounting for allowance for bad debts for the first year is different from the way you account for the same for subsequent years. So for the first year, we debit profit and loss account as an expense. Then we credit provision or allowance for bad and doubtful debt account. So that is the first year. and that is we credit and debit these accounts with the amount of the provision. You determine what with the provision. It could be a percentage of the data, maybe 5% of the data. You are expecting that the 5% of the data will not pay. That's what we are referring to as a provision. You are making provision in the book that out of the data that you have, 5% or 10% may not pay. So you first determine the provision. Then after you get the provision, that amount, if it is 1 million, then you debit the profit and loss account. It's treated as an expense. Then you credit the provision for bad and doubtful debts. That is the first year. Please pay attention. Then you have subsequent periods. Subsequent periods. After first year, how do you account for allowance for bad and doubtful debts? Subsequent. How do you account for provision for bad and doubtful debts for subsequent years? Now, in subsequent periods, it will depend on whether the provision is an increase or a decrease. How you account for the allowance for bad and doubtful debts in subsequent years will depend as to whether the provision is an increase or a decrease. Two factors there, two things. Increase or decrease. Is the provision increasing in subsequent year or decreasing? So if it is decreasing, what entries do you make? If it is increasing, what entries do you make? So initially, candidates, let me use accounts. First year of trading, debit P&L, credit provision for bad or doubtful debts. So we have provision for bad and doubtful debts account. The first year there, candidates, you can see we debit P&L, then credit provision. So you have here P and L, 200,000. Then we debit P&L. So we want to find out if the provision, first of all, increases. So you can see, candidates, in year one, this is year one. If you are to close this account in year one, we'll have balance carried down here, 200,000. So we close it. In year two, subsequent year, we have balance brought down of 200,000. So already this account has a balance from last year. This is balance at the beginning. Brought down is a beginning, 200,000. Now, assuming that this provision increases, if the provision increases, then we have to credit this provision. If it is increases by, say, 100, so you have to credit because it has a credit balance. P&L. So that's what you do if it increases. This is an increase. So year 1, we close it 300. Balance carried down 300. Please pay attention. Please pay attention. Pay attention. This is year 2. So if a provision increases, we credit the provision for bad debts account, debit P&L account. So it increased in year 2. So in year 3, we'll have this balance brought down 300,000. Assuming in year 3, the provision reduces. It reduces by, say, 50,000. If it's going to reduce by 50,000, then we are going to debit the provision for bad debts, 50,000. And then we credit the P&L account. So you see, at the end of year 3, we have a balance carried down of 250. So accounting for allowance for bad or doubtful death, that accounting for provision for bad and doubtful death depends on 2 things. Accounting treatment for provision of doubtful debts depends on 1, the year of trading. So if it is the first year, this is the accounting treatment. If it is the first year, depends on first year, then we have subsequent years. If it is subsequent years, if you're accounting for bad or doubtful debts in subsequent years or periods, then again it depends on whether the provision is an increase or a decrease. If it is an increase, we credit the provision for bad and doubtful debts. If it is a decrease, this is a decrease, we credit this account. Illustration. Let's reinforce what we've learned with an illustration. Illustration. Tamim Limited started trading on 1st January 2013. It has been adjusting its doubtful debts provision at the end of each year on percentage basis. But each year, the percentage rate is adjusted in accordance with economic performance in the country. The following details are available for years ended 31st December 2023, 2024, 2025. So we have the year, we have the bad debts written off, we have the debtors at year end, then you have provision for bad and doubtful debts required. Roman 1, bad debts account for the 3 years. Roman 2, provision for bad and doubtful debts for the years 2013 to 2015. Year 3, the balance sheet extracts on the year for the years 2013 to 2015. So we are required, first of all, to prepare bad debts account for the 3 years. So we begin with bad debts account for the 3 years. So we have the bad debts written off in 2013 at the end of year 2013 is 656,000. So just use one account. This is 2013 December 31st. We say that when you write off bad debts, this is 2013 December 31. When you write off bad debts, what happens? Which accounts are affected? When you write off bad debts, you have to open bad debt account from the question. Look at the question again. So the initial entry, you recall what I wrote here. When you write off a bad debt, writing off bad debt, the first transaction, it affects the debtors account. You are not required to open debtors account, but I'm opening this for learning purposes. If there was a balance on this account, this is that was 50 something. So part of this balance will not be paid. So that means to reduce that balance, we credit this debtors account with the bad debt. Crediting the debtors account reduces the balance on the debtors account, and the amount is 656. So this account is credited 656. The corresponding entry is to debit the bad debts account. So we write here debtors. There are 3 zeros there, 656. Then this is in 2013 at the end. Because this is an expense, we have to close this account to the profit and loss account. So we debit the same account, P and L, we credit this account and debit P and L account, the amount 656. So this will close it. We balance it off, then we close the account. So it is closed. There is no balance. The bad debt, by crediting this bad debt account, we have closed it to the P and L account. That is in 2013. In 2014, there was also a bad debt written off. So we debit this account, December 31, debtors. What was the amount? In 2013, from the information there, is 1,805,000. 1,805,000. Again, this we close to the profit and loss account. December 31, profit and loss account, 1805. We close that account. Close it. 1805. There was also a bad debt written off in 2015. December 31. Debtors. What is the amount? The amount is 3,817. 3,817. 2015. Close that account to P&L. P&L 3,817. We close it. Close the account. 3,817. So that is how to prepare the debtors account. Credit debtors account, debit bad debts account, close the bad debts to P&L. Is that clear, candidates?